Hello, I'm Thorsten Beck. I'm the director of the Florence School of Banking and Finance, and I would like to talk with you today about the economics of cooperation between supervisors across borders. Bank failures affect not only owners or shareholders of banks, but also the broader public. We can describe these negative effects or these negative externalities with three concepts. First, the domino effect. One bank failure often leads to failure of other banks because they are closely interlinked with each other. Two, there is a hostage effect. The depositors of the bank might get nervous and might withdraw their deposits in a panic, or their savings might get stuck in a failing bank without them having access to it. And three, there's the fridge effect. Like milk, when you take it out of the fridge in a hot summer day, lending relationships between enterprises, households on the one side and the banks on the other side rely on close relationships with loan officer and branch manager. If a bank fails, these lending relationships go away and households, enterprises might lose access to external funding. For all these reasons, banks are closely regulated across countries, across the globe. But they are supervised by national supervisors. Now imagine a cross-border bank with depositors and borrowers in other countries. The failure of this bank does not only affect the broader public in its own country, but also in other countries where it has branches or subsidiaries. The regulator of the bank, however, in the home country, is tasked with preventing these negative effects only in the home country, not in the other country. This might result in inefficient supervisory decisions, as home supervisors do not necessarily take into account the costs of bank failures imposed on other countries. Now that's just not theoretical. We've also seen this actually in practice during the global financial crisis in 2008 and 2009. Now incentives are one friction, but there are also other frictions. Limited possibilities, for example, to share soft information that goes beyond financial indicators. There might be different supervisory cultures or even legal constraint to share information with authorities in other countries. These inefficiencies or this asymmetry between cross-border banks and national supervision have been recognized early on, and supervisors have started to cooperate across borders. Memorandum of Understanding have been signed in which supervisors commit to the exchange of information. The supervisor of the parent bank, also known as the home supervisor, often convenes colleges of supervisor, which includes supervisors of other countries where this bank has subsidiaries. The 2008 crisis, however, has shown that these traditional tools of cooperation might not be sufficient. Memorandums of Understandings are not legally binding documents as they do not have the status of a treaty. One can even go so far and say that the value of a Memorandum of Understanding follows the share price of the bank it refers to. As the share price of a failing bank tumbles towards zero, national supervisors are primarily concerned with the stability within their own country and less about sharing information with supervisors in other countries. So the value of this commitment, this Memorandum of Understanding, basically goes to zero. Further, colleges of supervisors are for exchange of information, but they're not decision entities. In crisis situation, every supervisor decides on her own. This is not to say that these instruments are not important, simply that they're not sufficient, especially when it comes to address the failure of a cross-border bank. Over the past decade, therefore, increasing emphasis has been put on preparing joint crisis responses, going beyond colleges of supervisors towards colleges of resolution authorities and crisis management groups. A special focus has been put on globally, systemically important banks in terms of coordination between national supervisors, preparation of recovery and resolution plans, and higher capital buffers. The Financial Stability Board in Basel has also played a very important role in this context. Some regions of the world have gone even further. More specifically, In the euro area, the single supervisory mechanism was created directly responsible for the supervision of the largest 130 banks. This supervisor should take into account financial stability concerns of the whole euro area, not only of individual countries, such as national supervisors would. A single resolution mechanism was created to coordinate the resolution of failing banks. However, there are also elements still missing, including incomplete funding for the resolution of failing cross-border banks and a common deposit insurance scheme.